What's your take, I guess, on this data, but how it adds to the overall jobs picture and whether it implies the Fed should be moving faster or not?
Well, it's reflecting near record high job openings and labor shortages that we're seeing left and right. So from a claim standpoint, which is measuring the pace of firings, companies are holding on tight to their existing employees and desperately searching for more. I think what was encouraging, as Rick pointed out in today's number, is that the continuing claims component, which is delayed by a week in its reporting, is back to where it was pre-COVID. Now, we still have more jobs to fill relative to where we were in February 2020, but at least from a pace of hiring standpoint a pace of firing standpoint, we're back to where we were pre-COVID, showing the tightness of the labor market that's now being reflected in much higher wages.
I know, Peter, that you're a believer in inflation persisting for longer than others expect, maybe not right at the peaks that we're seeing now, but nonetheless higher than it should be. What percentage chance or what likelihood do you put there being of stagflation next year, of something that really also comes alongside derailing the economy?
I think it's a high risk, and we saw bouts of it this year. I mean, we have, because of the lack of supply of autos, we had a recessionary level of auto sales in 2021. We're going to do about 15 million of, less than that, 13 million of auto sales this year. And relative to the 16.5 to 17 we did pre-COVID, not for lack of demand, but for lack of supply. So it is a stagflationary type situation in certain areas, different than the 70s. The 70s had much higher unemployment. So it's a fluid definition in a way. But yes, I think sticky inflation, moderating growth, and interest rate and Fed tightening, along with global tightening, is the biggest challenge for 2022.
You have a couple of interesting ideas, Peter, about how people should play some of the themes next year. One of them is Macau casinos. So
I do think that, well, I'm hoping that after the Olympics that China begins to relax some of its very strict COVID protocols and restrictions. And Macau is the Las Vegas of Asia, with billions of people, not just in China, but obviously in that entire region. These stocks have gotten hammered. They're incredible properties. This is the Las Vegas of Asia. And I think that if someone's looking for value in an area that's been beaten up, this is one of them.
What chance, though, do you put on there being some growth problems internationally in general, China, Asia, but also Europe, and the level to which that could hurt U.S. equity sentiment next year?
Well, in a way, there's been much more restrictive policies in response to COVID in Europe and Asia. So if Omicron hopefully is sort of the last leg of this in terms of influencing and being a force in our lives, there's a lot of recovery potential in Asia and in Europe relative to the U.S. So to me, the biggest risk for U.S. markets is how they respond to Fed tightening. And not just Fed tightening. There's monetary tightening going on around the world. And particularly with the bigger banks, with the ECB, the Bank of England, Bank of Canada, Reserve Bank of Australia, with the Bank of Japan being, of course, the last one to tighten.
Shepard Smith here. Thanks for watching CNBC on YouTube.